Welcome to the SafeSimpleSound podcast, where our constitutional approach to financial planning creates both and solutions for the contradictions families face every day. I'm speaking with you today, drawing from our team's chartered financial consultant background and our S3 framework development. Today marks a significant milestone. We are arriving at the summit of our three-part series, The Anatomy of Loss. If you've been walking with us through the previous episodes, you know that at SafeSimpleSound, we view financial safety not just as a number in a bank account, but as a systematic defense against hazards. In Part 1, we looked at the physical hazards, the risks to your property and health. In Part 2, we explored the human factor, how behavior and legal structures shape your risk. Today, in Part 3, we are tackling the topic that keeps most people awake at night: your investment portfolio. We are exploring the concept of systemic defense. We recently wrote about this extensively on the SafeSimpleSound blog because we noticed a pattern in our practice. When families think about losing money, they often view the stock market as a single, terrifying monster. It's a source of anxiety, confusion, and often paralysis. But through our S3 financial planning approach, we know that clarity cures anxiety. The market isn't one single monster. It actually contains two very different types of giants. And when you can tell them apart, you can defeat them. Whether you are just starting to save or you are navigating the complexities of retirement distribution, this episode will give you the sound, systematic defense you need. We're going to break down the difference between systemic and idiosyncratic risk. Big words, we know, but we'll make them simple and show you how constitutional thinking turns a gamble into a fortress. From a SafeSimpleSound perspective, this provides the stability we look for. It transforms the unknown into the manageable. So, take a deep breath and let's climb this final summit together. Let's begin by addressing the safe component of our framework. To feel safe, we must understand what we are looking at. In our practice, we often hear clients express a general fear of the market crashing. It's a valid feeling. But to build a sound plan, we need to be specific. Drawing from our Chef C background at SafeSimpleSound, our approach suggests that we need to bifurcate or split this fear into its two actual components. There are two distinct types of risk you face when you invest. One is a hazard you should never take. The other is a hazard you must take to grow your wealth. Confusing the two is where most financial pain comes from. Let's start with the first giant: idiosyncratic risk. That's a technical term, so let's make it simple. Idiosyncratic risk is the specific hazard inherent to a single company or a specific asset. It is the risk that belongs to one thing. Imagine you own stock in a single company. Let's call it Company A. Idiosyncratic risk is the list of things that can go wrong just for Company A. Maybe the CEO quits unexpectedly. Maybe a warehouse burns down. Maybe a new competitor invents a better product that makes Company A obsolete. If you own only that one stock, this risk is massive. If that company fails, your financial plan fails. It is an all-or-nothing scenario. Now here's the constitutional truth that drives our S3 philosophy. You are not paid to take this risk. This is a critical distinction. The market, generally speaking, rewards risk, but it does not reward unnecessary risk. Because you can easily eliminate idiosyncratic risk by buying a fund that holds hundreds of companies, the market offers no risk premium for betting on just one. Think of it this way. If you choose to walk a tightrope without a net when there is a perfectly safe bridge right next to it, you don't get a prize for falling off the rope. You just get hurt. That is idiosyncratic risk. Now let's look at the second giant: systemic risk. This is the market hazard. This is the risk inherent to the entire economic system. This isn't about one CEO quitting. This is about the economic weather. Inflation rises, a global recession hits, geopolitical conflict erupts. When systemic risk strikes, it's like the tide going out. All boats lower together. You cannot escape this risk just by switching from Apple to Google, because both are swimming in the same ocean. Here's the S3 truth regarding systemic risk. This is the risk you are paid to take. Over the long term, the market has historically rewarded investors for enduring this volatility. This is the price of admission for the returns that beat inflation and build wealth. So we have a dilemma, a contradiction. On one hand, we have risks that can destroy us, idiosyncratic. On the other hand, We have risks we need to accept to grow systemic. Traditionally, investors get stuck in an either-or trap. They think, either I take huge risks and gamble to get growth, or I stay in cash, avoid all risk, and slowly lose my purchasing power to inflation. This anxiety is the enemy of the safe principle. It creates stress. The constitutional approach uses both and thinking to resolve this. We don't choose between safety and growth. We engineer a system that accommodates both. How do we do that? Through two primary tools, diversification and hedging. Let's break this down using our S3 simple filter. First, we eliminate idiosyncratic risk through diversification. If idiosyncratic risk is the danger of one company failing, the solution is to own thousands of companies. We don't try to pick the needle in the haystack. We simply buy the whole haystack. By owning a globally diversified portfolio, we effectively neutralize the risk of any single CEO, warehouse, or lawsuit destroying your wealth. If one company fails, it is a microscopic dent in a massive shield. This makes the portfolio safe. Second, we manage systemic risk through asset allocation, or hedging. Since we cannot eliminate the risk of a recession or a market crash, that's the systemic risk, we prepare for it. We recognize that winter comes for the economy just as it comes for the seasons. We hold non-correlated assets like high-quality bonds, cash reserves, or fixed instruments. These act as shock absorbers. When stocks fall, which they will temporarily, these safe buckets provide stability. They ensure you aren't forced to sell your stocks at the bottom to pay for groceries. This is sound. By combining these, we move from gambling to investing. We eliminate the risk we aren't paid for, and we manage the risk we are paid for. To illustrate this constitutional principle in action, let me share a hypothetical scenario that illustrates how these concepts play out in real life. While this story is created for educational purposes, it demonstrates patterns we see when families apply S3 thinking to retirement planning. Consider a fictional couple. Let's call them Arthur and Martha. Arthur and Martha are approaching retirement. They have worked hard, saved diligently, and built a nest egg. But they approach their finances with two very different mindsets, creating a tension in their planning. Arthur is focused on growth. He has a friend who made a fortune investing in a specific tech startup. Arthur believes that to secure their retirement, they need to find the next big thing. He wants to put a large portion of their savings into a single sector, let's say artificial intelligence stocks. In our framework, Arthur is courting idiosyncratic risk. He is trying to pick the needle. Martha, on the other hand, remembers the financial crisis of 2008 vividly. She saw their balance drop, and the fear of that happening again paralyzes her. She wants to move everything into cash or gold. She wants to avoid the pain of loss entirely. Martha is reacting to systemic risk by trying to exit the system entirely. Now, in a traditional setting, this couple might fight. It's an either-or battle. Either they gamble like Arthur, or they hide like Martha. However, let's look at how we would address this through our SafeSimpleSound practice. First, we would validate both of their feelings. Arthur's desire for growth is valid. They need to beat inflation. Martha's desire for safety is valid. They cannot afford to lose their lifestyle. We would then apply the sound constitutional framework. We would explain to Arthur that by betting heavily on the AI sector, he is taking a risk the market won't pay him for. If that sector faces a regulatory crackdown, their retirement is in jeopardy. Instead, we would structure their portfolio to own the entire market, including AI, but also healthcare, consumer goods, energy, and thousands of other companies across the globe. We eliminate the specific hazard of the AI bubble popping while still capturing the growth of the global economy. Arthur gets his participation in growth, but without the gamble. Then we turn to Martha. We acknowledge that the global economy's systemic risk will have bad years. To address her need for safety, we don't put everything in cash which loses to inflation, but we build a war chest, a specific allocation of bonds and stable instruments equal to several years of their income needs. We tell Martha, even if the market crashes tomorrow, your income for the next 5 to 7 years is sitting in this stable bucket. You won't have to sell a single share of Arthur's growth portfolio while the market is down. Analysis of the scenario. While Arthur and Martha are fictional, their situation demonstrates exactly how the SafeSimpleSound framework operates. Notice what happened here. We didn't compromise. We didn't say, let's take a medium amount of risk. That's a lukewarm solution that satisfies no one. Instead, we used both and thinking. We used diversification to satisfy the need for growth without the danger of betting on one horse addressing idiosyncratic risk. We used asset allocation to satisfy the need for stability without abandoning the ability to grow managing systemic risk. This example shows patterns we observe when families move from emotional investing to constitutional planning. When Arthur understands that he owns the whole haystack, he stops worrying about picking the winner. When Martha understands that she has a shock absorber, she stops worrying about the daily weather of the market. Through our S3 practice, we've observed that this specific structure creates what we call time coexistence. The portfolio respects the long-term data that the market goes up over time, while respecting the short-term reality that the couple needs money to live on today. It is safe because it removes the fear of ruin. It is simple because the rules are clear. And it is sound because it is based on decades of economic evidence, not a hunch. Whether you are facing this exact situation or something similar, the principle remains the same. You must identify which giant you are fighting. Are you worried about a specific company failing? Diversify. Are you worried about the market crashing? Hedge with safe assets. Doing both is the essence of a systematic defense. As we wrap up this episode and our three-part series on the anatomy of loss, let's summarize the constitutional insights we've uncovered. We have traveled a long way. We started by fixing physical hazards in your home. We moved to aligning your behavior and legal integrity. And today, we've arrived at the fortress of your investment portfolio. The difference between a gambler and a SafeSimpleSound investor is clear. A gambler takes idiosyncratic risk, betting on one horse, and prays for luck. An S3 investor eliminates idiosyncratic risk, accepts systemic risk, and builds a plan to endure it. This is the ultimate sound wisdom. It allows you to stop looking at the market as a monster and start seeing it as a tool. Understanding these concepts is powerful, but we know that execution is what actually changes your life. You need to know exactly where your current investments sit on this risk spectrum. Are you taking risks you aren't being paid for? Do you have a shock absorber in place? This episode draws from our recent blog post, Systemic Defense, which you can find at SafeSimpleSound.com. Through our S3 approach development, we've created 2 advanced tools to help you complete this journey, which are available on the site. First is the Systemic Defense Matrix. This is a strategic guide to visualizing where your current investments sit. It helps you see if you are holding a needle or the haystack. Second is the S3 Total Hazard Mitigation Master Plan. This is the capstone. It's a complete framework that integrates your physical, behavioral, and investment defenses into a single annual calendar. It takes all 3 parts of this podcast series and turns them into a checklist for your financial life. If today's S3 insights resonate with your family's situation, we invite you to explore what constitutional financial planning could look like through our Safe, Simple, Sound practice. We love helping families build these fortresses. But even if you choose to implement this on your own, you are now equipped with a constitutional capability that will serve you well. You know the difference between the risks you should take and the risks you shouldn't. You know that you don't have to live in fear of the perils. When you systematically manage the hazards, safe, simple, and sound, you build a future that can weather any storm. Thank you for listening to the Safe, Simple, Sound podcast. We look forward to being with you again soon as we continue to explore the constitutional principles of financial well-being. Until then, keep it safe, keep it simple, and keep it sound.